Before we begin, please remember that I am not a licensed financial advisor, and this presentation is for educational and informational purposes only. The content of this video should not be considered financial, investment, legal, or tax advice. Investing involves risk, including the potential loss of principal. You should always conduct your own research and consult with a qualified professional before making any investment decisions. There are over 7,000 mutual funds available to investors in the United States. 7,000. And here is a terrifying secret that Wall Street doesn't like to advertise. The vast majority of them aren't very good. In fact, according to the latest Spiva report, which tracks these things, over a 15-year period, more than 92% of actively managed large-cap funds failed to beat their benchmark, the S&P 500. Let me say that again. More than 9 out of 10 professional fund managers, with their teams of Ivy League analysts and their billion-dollar research budgets, took people's money, charged them fees, and then proceeded to underperform a simple low-cost index fund that anyone can buy. So if the pros are failing this badly, what chance do we have? We're faced with a wall of choice that leads to a state of paralysis. You log into your brokerage account, you see thousands of options, each with a fancy name and a slick marketing brochure. You see tickers and charts, alphas and betas, Sharpe ratios and standard deviations. It feels like you need a PhD in advanced mathematics just to understand the label. You hear one guru on TV telling you to buy international growth, while another podcast host swears by domestic value. You see a fund that was up 40% last year and you think, that's the one, only to be paralyzed by that tiny gray font warning at the bottom of the page. Past performance is not indicative of future results. This is the exact problem we are going to solve together in this series. We are going to cut through the noise, demystify the jargon, and build a systematic, repeatable framework that you can use for the rest of your life to identify high-quality mutual funds with a strong, durable track record. This isn't about finding a hot tip for next quarter. This is about learning how to become an intelligent, confident investor. We're going to turn that feeling of overwhelming anxiety into a feeling of disciplined clarity. My promise to you is that by the end of this, you will have a checklist, a mental toolkit, that allows you to look at any mutual fund and within minutes determine if it's even worth a deeper look. The fundamental mistake most people make is that they approach mutual fund research backward. They start with performance. They screen for funds with the highest returns over the last 1, 3, or 5 years. This is like trying to drive a car by looking only in the rearview mirror. It tells you where you've been, but it gives you zero reliable information about the road ahead. That celebrated fund manager who knocked it out of the park last year? They might have just gotten lucky. They might have made one concentrated bet on a single stock that paid off. They might have a high-risk strategy that works great in a bull market, but will get absolutely crushed in a downturn. Chasing past performance is a recipe for buying high and selling low. Our framework flips this entire process on its head. We don't start with the numbers. We start with the people. We start with the philosophy. We become investment detectives, not performance chasers. We look for the causes of good performance, not just the performance itself. Our framework is built on 5 core pillars, and we're going to dedicate time to mastering each one. Think of them as the 5 essential questions you must answer before you ever invest a single dollar. The 5 pillars are the manager, the philosophy, the process, the performance, and the price. First, the manager. Who is actually running the show? Is it a single-star manager or a team? How long have they been in charge? What's their background? Do they have skin in the game, meaning do they invest their own money in the fund alongside you? Second, the philosophy. What is the fund's core belief system? Are they looking for fast-growing companies or undervalued, forgotten ones? Do they believe in concentrating their bets on a few great ideas or diversifying widely? A clear, consistent philosophy is the bedrock of long-term success. Third, the process. How do they turn that philosophy into an actual portfolio? What is their day-to-day method for finding, researching, and selecting investments? Is it repeatable and disciplined? Or is it haphazard and based on gut feelings? Fourth, the performance. Yes, we will look at performance, but we're going to look at it the right way. We won't be seduced by a single good year. We'll analyze performance over full market cycles, both bull and bear markets. How did the fund hold up during the 2008 financial crisis? How did it perform during the 2020 crash? We care more about consistency and risk management than we do about short-term, flashy returns. And finally, fifth, the price. What is this all going to cost you? We'll dig into the expense ratio and other hidden fees that can eat away at your returns over time. A great fund at a terrible price can quickly become a mediocre investment. So let's dive into that first and arguably most important pillar, the manager. Imagine you're boarding a flight from New York to Los Angeles. Would you be more confident knowing the pilot is a 25-year veteran with thousands of hours of flight time, who has successfully navigated storms and engine trouble, or a rookie on their first long-haul flight? It's a no-brainer. Yet, millions of people hand over their life savings to mutual funds without ever even asking who is in the cockpit. A mutual fund is not a computer algorithm or a faceless corporation. It is a portfolio of stocks or bonds chosen by a human being, the fund manager. The single greatest predictor of a fund's future success is the skill, temperament, and experience of that manager. So, how do we investigate them? The first thing you need to find is manager tenure. This tells you how long the current manager has been running this specific fund. You can find this information for free on sites like Morningstar or even Yahoo Finance. Look for the fund's ticker symbol, and on the main profile page, there will be information about the management team. Why is tenure so critical? Because that track record you see belongs to the person who created it. If a fund has a fantastic 10-year record, but the manager who achieved it just retired last month and was replaced by someone new, that 10-year record is now almost completely irrelevant. You are investing with the new manager, not the old one. I look for managers who have been at the helm for at least 5 years, and preferably 10 or more. This shows they have experience managing the fund through different market environments, not just a raging bull market where everything goes up. It also demonstrates a level of commitment to the fund and the firm. High manager turnover is a massive red flag. Next, you want to understand the manager's background. Where did they come from? Did they work as an analyst at the same firm for years, learning the specific investment philosophy before taking over? Or were they hired from the outside? You can often find manager biographies on the mutual fund company's own website. Look for experience that aligns with the fund's strategy. If it's a healthcare fund, does the manager have a background in science or medicine? If it's a technology fund, did they work in the tech industry? This isn't a requirement, but it can provide a significant edge. Finally, and this is a pro-level tip, you need to check if the manager has skin in the game. This means, do they personally invest a significant amount of their own money in the very fund they are managing for you? This is the ultimate alignment of interests. When a manager has their own retirement savings on the line, you can be sure they are going to be far more careful and motivated to protect the capital and grow it prudently. You can find this information in a document called the Statement of Additional Information, or SAI. It's a bit buried, but fund companies are required by law to disclose it. Morningstar also often reports this, showing manager ownership in tiers, from zero investment up to over $1 million. When I see a manager with over $1 million of their own money invested right alongside their shareholders, my confidence in that fund goes up exponentially. Tells me they truly believe in their own strategy. So, your first step in researching any fund is to play detective on the manager. Find their name. Check their tenure, is it over 5 years? Look up their background, is it relevant? And check their ownership, do they have significant skin in the game? Answering these questions alone will allow you to eliminate hundreds, if not thousands of mediocre funds from your list, before you even look at a single performance chart. So you've filtered for experienced managers who eat their own cooking. Fantastic! You've just cut through a massive amount of noise. But a great chef is nothing without a great, consistent recipe. And that's our next step. Dissecting the fund's core philosophy and strategy. This is where we move from the who to the what and the how. What is this fund actually trying to do, and how does it plan to do it? Ignoring this step is like hiring a world-renowned builder without ever looking at the blueprints for your house. You might get a masterpiece, or you might get something that looks nothing like what you envisioned. The fund's blueprint is a document that most investors skip because, let's be honest, it's designed to be boring. I'm talking about the prospectus. Now stay with me. I know the word prospectus can induce a coma. It's a legal document, dense and filled with jargon. But I want you to reframe how you see it. Don't think of it as a legal chore. Think of it as the fund's constitution. It is the legally binding document where the manager has to, by law, tell you exactly what they will and will not do with your money. It's their sworn oath to you, the investor. And reading just a few key sections can give you an incredible edge. You don't need to read all 150 pages. You're looking for 2 specific sections: investment objective and principal investment strategies. First, the investment objective. This is the one-sentence mission statement. Is the fund aiming for long-term capital growth? Is it trying to generate current income? Is it focused on capital preservation? This sounds basic, But you'd be shocked how many people own funds that are completely misaligned with their own personal goals. If you're 30 years old and saving for retirement, a fund whose primary objective is capital preservation is probably not aggressive enough. If you're 70 and living off your investments, a fund aiming for aggressive growth in speculative small-cap stocks might give you a heart attack. The objective is the destination on the GPS. Make sure it's going where you want to go. But here's where the real magic happens. The Principal Investment Strategies section. This is the turn-by-turn directions. This is where the fund manager has to lay their cards on the table. And this is where you can spot the difference between two funds that look identical on the surface. Let's take an example. You're looking at two funds. Both are called U.S. Large Cap Growth Fund. They sound the same, right? You check their objectives, and both say they seek long-term capital appreciation. Still the same. But then you dig into their strategies. Fund A's strategy section says something like, the fund invests in high-quality, durable franchises with sustainable competitive advantages, strong balance sheets, and high returns on invested capital. We seek to purchase these businesses at reasonable prices and intend to hold them for many years, allowing the power of compounding to work. Fund B's strategy section says, the fund seeks to identify companies with powerful near-term earnings and sales momentum. We utilize quantitative screening models to find stocks exhibiting strong relative price strength and may engage in frequent trading to capture short to medium-term trends. Do you see the difference? It's night and day. Fund A is a classic Warren Buffett-style buy-and-hold quality investor. They're buying businesses. Fund B is a momentum-driven, rapid-fire trader. They're buying stock charts. Neither one is inherently better than the other, but they are fundamentally different investment recipes. One relies on the long-term success of the underlying business. The other relies on predicting short-term market psychology. Which recipe do you believe in? Which one makes more sense to you? Which one do you think is more repeatable over the next 10-20 years? By understanding the strategy, you're no longer just betting on a track record. You're investing in a process you understand and believe in. This is the key to being able to stick with a fund during the tough times. When the market is crashing, you won't panic and sell if you have deep conviction in the process, not just the recent performance. While you're in the prospectus, there's one more critical section: principal risks. This is the part everyone ignores. It's the side effects may include warning label on your investment. Again, don't just skim it as legal boilerplate. Read it carefully. Is the fund highly concentrated in a few stocks or a single sector like technology? The prospectus has to tell you that. Does the fund use derivatives or leverage, which is borrowed money? That's a massive risk amplifier, and they have to disclose it. Does it invest heavily in foreign markets, exposing you to currency risk? It'll be in there. The risk section tells you what could blow the fund up. It's the pre-mortem. Understanding what can go wrong is just as important as understanding what they hope will go right. Okay, so you've read the fund's constitution. You understand its objective, its strategy, and its key risks. You've moved from the 99th percentile of investors to the 99th.9. But we can go deeper. The prospectus tells you the what and the how. Now we need to find the why. We need to get inside the manager's head. And the best way to do that is by reading their letters to shareholders. These are the annual or semi-annual reports where the manager speaks directly to you, the owner. This is where you separate the true investment thinkers from the corporate marketing machines. A bad shareholder letter is easy to spot. It's filled with jargon. It brags about performance in good years and blames the Federal Reserve, the economy, or market volatility in bad years. It takes credit for everything and responsibility for nothing. It's a sales pitch. A great shareholder letter is a masterclass in clear thinking. The manager will speak in plain English. They will walk you through their biggest winners and their biggest losers from the past year. They will openly admit their mistakes, explain what they learned from them, and detail how they're adjusting their process. They will spend more time talking about the future outlook and the positioning of the portfolio than they do bragging about the past. They are teaching you how to think about the market through their eyes. Warren Buffett's letters for Berkshire Hathaway are the gold standard for a reason. Find a manager who writes like they're a partner educating you, not a salesperson trying to impress you. These letters are almost always available for free on the fund company's website. Go back and read the letters from a tough year like 2022 or the fourth quarter of 2018. How did the manager communicate? Were they calm and resolute, explaining why they were sticking to their process? Or did they sound panicked? Their tone during turmoil tells you everything. Beyond shareholder letters, look for interviews. Has the manager been on CNBC, Bloomberg, or a popular investing podcast? Have they written articles for financial publications? Search for their name on Google or YouTube. Hearing them explain their philosophy in their own words is invaluable. Do they sound as smart and thoughtful as they do in their writing? Is their story consistent? If you listen to an interview from 2015 and another from last week, are they still singing the same tune, applying the same core philosophy to a different market? Or have they drifted? This concept of style drift is a colossal red flag. This is when a manager, facing a period of underperformance, abandons their stated strategy to chase whatever is hot. A value investor who suddenly starts buying profitless tech stocks because they're going up. A small cap specialist who starts loading up on Apple and Microsoft because their small cap strategy isn't working. Style drift shows a lack of conviction. It means the manager doesn't truly believe in their own recipe, and they're willing to throw it out the window at the first sign of trouble. The prospectus is their promise, and style drift is them breaking that promise. A strong track record is meaningless if the person who generated it is no longer following the same process. By combining the legal blueprint of the prospectus with the intellectual and philosophical color from shareholder letters and interviews, you build a powerful, three-dimensional picture of the fund. You're not just looking at a name and a ticker symbol. You understand its purpose. You understand its process. You understand its people. And now, with this deep qualitative understanding, we are finally ready to talk about numbers. But not in the way most people do. We're not going to just look at a 5-star rating or a 1-year return. We're going to dissect performance in a way that reveals skill, not just luck. We're going to look at risk, at cost, and at the hidden metrics that truly define a fund's long-term track record. That's coming next. So let's start with the most obvious metric, performance. But we have to look at it differently. Forget the 1-year return. A 1-year return is a snapshot, not a movie. Tells you nothing about consistency. Any fund manager can get lucky for a year. They can make one concentrated bet on a hot tech stock or a trendy sector and look like a genius. But what happens the next year when that trend fizzles out? That's like judging a marathon runner based on their first 100-yard dash. It's meaningless. Instead, we need to look for patterns of success over long periods and through different market cycles. The first and most basic step up from the 1-year return is to look at the 3, 5, and 10-year annualized returns. This gives you a much better sense of the fund's long-term horsepower. But even this can be misleading. Why? Because the start and end dates can dramatically skew the picture. If a 10-year period starts at the absolute bottom of a market crash like March 2009 and ends near a market peak, almost every fund will look incredible. Conversely, if it starts right before a crash, the numbers will look terrible. So how do we solve this? How do we see the true consistency of a fund? The answer is a professional-grade metric called rolling returns. Now, stay with me because this concept is the single most powerful way to evaluate performance, and it's simpler than it sounds. Imagine you want to see how a fund did over every possible 3-year period in the last 15 years. A rolling return calculates that for you. It shows you the return from January 2008 to January 2011, then from February 2008 to February 2011, then March 2008 to March 2011, and so on for every single month. What you get is not one single number, but hundreds of data points that show you how the fund performed across a vast range of market conditions. This tells you a story. You can see the best 3-year period the fund ever had, and the worst. Most importantly, you can see its average performance over all those periods. A fund that consistently delivers an 8% or 9% return across hundreds of different rolling 3-year periods is demonstrating skill. A fund that has a few periods of plus 40% and a bunch of periods of minus 20% is demonstrating luck and volatility. We're looking for the steady hand, the manager who can navigate both storms and calm seas. Another great tool is looking at calendar year returns. Go back 10 or 15 years and look at the fund's performance for each individual year. 2008, 2009, 2013, 2018, 2020. How did it do? Did it get absolutely obliterated during the 2008 financial crisis compared to its peers? Or did it protect capital better than most? How did it perform in the roaring bull market that followed? Seeing these year-by-year numbers reveals the fund's personality. Some funds are built like tanks. They don't capture all the upside in a great year, but they protect you fiercely in a downturn. Others are built like sports cars. They give you a thrilling ride up, but can crash and burn when the road gets rough. There's no right or wrong answer, but you need to know what kind of vehicle you're getting into. So, for performance, we're looking past the billboard number. We're looking for consistency through rolling returns and understanding the fund's personality through its year-by-year performance in different market cycles. But performance is only half the story. And frankly, it's the less important half. Because you can't evaluate a return without understanding the risk that was taken to achieve it. Think about it. If I told you I made a 50% return last year, you might be impressed. But what if I told you I did it by taking my entire life savings to Vegas and putting it all on red? Suddenly, that 50% return doesn't seem so skillful. Seems reckless. The same is true for mutual funds. The key is to find funds that deliver great risk-adjusted returns. They generate strong performance without making you ride a terrifying, gut-wrenching roller coaster. The first way we measure this is with a metric called standard deviation. All this number represents is volatility. It measures how much a fund's returns bounce around its average. A fund with a low standard deviation is like a smooth cruise on the highway. A fund with a high standard deviation is like off-roading on a bumpy mountain trail. Two funds might have the same 10-year average return of 10%, but if one has a standard deviation of 12 and the other has a standard deviation of 20, the first fund gave you a much smoother, less stressful ride to get to the same destination. For most long-term investors, lower volatility is better. Now let's combine these ideas of return and risk. The gold standard metric for this is the Sharpe ratio. The Sharpe ratio is a single number that brilliantly answers the question, am I being paid enough for the risk I'm taking? It measures the return of a fund over and above the risk-free rate, what you could get from a boring but safe treasury bill, and then divides it by the fund's volatility, its standard deviation. A higher Sharpe ratio is always better. It means you're getting more bang for your buck, more return per unit of risk. If you're comparing two funds and Fund A has a 10% return and a Sharpe ratio of 0.8, while Fund B has a 9% return but a Sharpe ratio of 1.1, Fund B is actually the superior choice from a risk management perspective. It's working smarter, not just harder. Finally, there's one risk metric that I find incredibly useful because it's so visceral: maximum drawdown. This tells you the absolute worst-case scenario. It measures the biggest percentage drop the fund has ever experienced from a peak to a trough. Seeing that a fund had a maximum drawdown of 55% during the 2008 crisis tells you something very real. It tells you that at one point, investors who bought at the top were looking at their account and seeing it was worth less than half of what they put in. Could you stomach that? Could you resist the urge to panic sell at the bottom? Knowing a fund's worst ever loss is a powerful gut check. It prepares you for the reality of investing. So now we have performance and we have risk. But there's a third silent factor that can destroy a great track record over time: cost. The single most important cost to understand is the expense ratio. This is the annual fee the fund charges to cover its operating expenses, the manager's salary, research, marketing, administrative costs. It's expressed as a percentage of your total investment. And while a number like 1% might sound tiny, it is the most reliable predictor of poor future performance. Think of the expense ratio as a constant headwind. If your fund's investments gain 8% in a year, but it has a 1% expense ratio, your actual return is only 7%. That 1% is gone forever. And that difference compounds into an astronomical amount of money over time. Let's run a quick example. You invest $25,000. Let's say it grows at an average of 8% per year for 30 years. If you're in a low-cost fund with a 0.15% expense ratio, your investment grows to over $238,000. Now, let's say you're in a fund with a 1.15% expense ratio, just 1 percentage point higher. After 30 years, your investment is worth only $180,000. That's a staggering $58,000 difference. $58,000 vanished from your pocket, not because of bad investments but simply because of higher fees. It's a guaranteed loss you agree to pay every single year, in good markets and bad. When you're researching funds, a lower expense ratio is almost always better. So, a truly strong track record isn't just a big number. It's a three-legged stool. It's built on consistent, repeatable performance, proven through rolling returns. It's supported by intelligent risk management, measured by metrics like the Sharpe ratio and a manageable drawdown. And its foundation is a low cost, a minimal expense ratio that lets you keep more of your own money. When you find a fund that excels in all three of these areas, you've moved beyond gambling and into the realm of professional-level investing. You found a fund that has demonstrated true, repeatable skill. Okay, we've defined the playbook. We know the key stats that separate the amateurs from the all-stars. But where do you actually find these numbers? How do you pull up a fund's Sharpe ratio or its maximum drawdown without getting a degree in finance? In the next part, we're pulling back the curtain on the exact free tools and websites you can use step by step to uncover all this critical data. Alright, your digital toolkit for this mission is surprisingly simple, and best of all, completely free. You don't need an expensive Bloomberg terminal or a secret Wall Street subscription. All you need is an internet connection and the willingness to look in the right places. Our first stop, and the undisputed heavyweight champion of mutual fund data, is Morningstar. Think of Morningstar as the encyclopedia of the fund world. It's dense, it's comprehensive, and it can be a little intimidating at first, but it holds the keys to everything we just talked about. So here's the game plan. You open your browser and go to Morningstar.com. You'll see a search bar right at the top. This is where you'll type in either the name of the mutual fund you're researching or, even better, its ticker symbol. A ticker symbol is just a unique, 5-letter code that ends in X for all mutual funds in the US. For example, the Fidelity Contra Fund is FCNTX. Using the ticker is faster and guarantees you get the right fund. Once you hit enter, you'll land on the fund's main quote page. Now your eyes will immediately be drawn to the famous Morningstar rating, the star system. You'll see 1 to 5 stars. Here is a critical piece of advice. Largely ignore it. The star rating is a backward-looking grade based on past performance and risk. It's a starting point, a filter, but it is not a buy signal. Great funds can have 3 stars and terrible funds can have 5 stars right before they crash. We are here to be detectives, not to just trust a sticker on the box. Instead, I want you to look at the navigation tabs just below the fund's name. You'll see options like quote, chart, performance, risk, and portfolio. This is our treasure map. First, click on the Performance tab. This is where you'll see the fund's historical returns. You can see its performance over the last month, year, 3 years, 5 years, 10 years, and even since its inception. But more importantly, you'll see how it performed against its benchmark index like the S&P 500 and its category average. This is your first major clue. Is this fund consistently beating the market and its peers? Or was its great performance a one-time fluke back in 2009? You want to see a pattern of outperformance across different time horizons. Now for the real power move. Click on the Risk tab. This is the section most amateur investors never even look at, and it's where you separate yourself from the pack. When you scroll down this page, you'll see a box, often labeled Morningside Risk-Adjusted Returns, or something similar. And right there, in plain English, you will find the fund's alpha, its beta, its R-squared, and most importantly, its Sharpe ratio. It's all calculated for you. You don't need a spreadsheet. You just need to know where to look. You can compare the fund's Sharpe ratio to its category average right there on the same page. Is it higher? Lower? This single number tells you if the manager is a skilled driver or a reckless one. Scroll down a little further on that same risk page, and you'll often find a section on drawdown. Morningstar will show you the fund's worst performance periods, telling you exactly how much it lost during market downturns like the 2008 financial crisis or the 2020 COVID crash. This is how you find out if you have the stomach to own this fund when things get ugly. Our second essential tool is Yahoo Finance. If Morningstar is the dense encyclopedia, Yahoo Finance is the easy-to-read, visually driven field guide. It's clean, it's fast, and it presents some information even more clearly than Morningstar. Again, you go to finance.yahoo.com and type the fund's ticker symbol into the search bar. The main page will give you a great interactive chart. This is Yahoo's superpower. You can easily change the date ranges from 1 day to the absolute maximum history of the fund. Even better, you can use the comparison button to overlay other tickers right on top of the chart. So, in seconds, you can visually plot your fund's performance directly against its benchmark like the SPY for the S&P 500 and another competing fund you're considering. A picture is worth 1,000 words, and seeing a fund's line consistently soaring above its benchmark on a chart hits differently than just reading numbers in a table. From the main page, look at the navigation tabs. Click on Holdings. This is incredibly important. This page shows you the fund's top 10 investments. Are they the same big tech companies every other fund owns? Or does the manager have some unique ideas? It also tells you the percentage of assets in that top 10. If a fund has 50% or 60% of its money in just 10 stocks, that's a highly concentrated, high-conviction bet. It could lead to massive gains or massive losses. It's a measure of risk you can see instantly. You can also see the breakdown of the fund by sector, how much is in technology, how much in healthcare, how much in financials. Does this align with your own view of the economy? Next, click on the Profile tab. This is where you find the human element. It will tell you the name of the fund manager, and crucially their tenure, the exact date they started managing the fund. If a fund has a stellar 15-year track record, but the current manager has only been there for 18 months, then that track record is irrelevant. You are not investing with the old manager. You're investing with the new one. This is a rookie mistake that trips up millions of investors, and you can avoid it by simply clicking this tab. Now for our third and final tool, the one that separates the serious researchers from the casual observers. The fund company's own website. This means going directly to Fidelity, Vanguard, T. Rowe Price, or whoever actually runs the fund. Why? Because this is the primary source. This is getting the information straight from the horse's mouth, with no third-party interpretation. Once you're on the fund company's site and you've navigated to the specific funds page, you're looking for a section called Documents, Literature, or Prospectus and Reports. Here you will find two documents that are pure gold: the prospectus and the most recent annual or semi-annual report. The prospectus is the fund's legal rulebook. I know it sounds boring, but you don't have to read all 100 pages. Look for the Investment Strategy section. Here the fund manager is forced to tell you, in their own words, exactly how they plan to invest your money. Are they looking for fast-growing companies? Undervalued, cheap companies? Do they use complex derivatives? This is their philosophy. Does it make sense to you? Then you must find the most recent shareholder report. This is where the real story is. Buried inside this report is a section called Letter to Shareholders, or Manager's Discussion. This is a letter written by the fund manager personally to you, the investor. In this letter, they will explain what worked and what didn't over the last period. They'll talk about their biggest winners and their biggest losers. They'll give you their outlook on the market. Reading this is like getting a direct look inside the manager's brain. Are they humble and honest about their mistakes? Do they have a clear, consistent process? Or do they just sound like they got lucky? The tone and substance of this letter can tell you more about a manager's skill than almost any other data point. So there you have it. Morningstar for the deep dive risk metrics, Yahoo Finance for the visual charting and holdings, and the fund's own website for the primary source documents and the manager's own thoughts. Using these three free tools in combination gives you a powerful 360-degree view of any mutual fund. You now know exactly where to find the raw numbers, the performance history, the risk statistics, and even the manager's own words. But having the data is only half the battle. A list of numbers doesn't make an investment decision. How do you synthesize all of this information? How do you weigh a great Sharpe ratio against a high expense ratio? What are the red flags hidden in a manager's letter that should make you run for the hills? In short, how do you connect all these dots to build a complete picture and make a final confident decision? That's exactly where we're going next. So let's start with the cost, the price tag on your investment vehicle, the expense ratio. What is a good number? Think of it like a tiny, almost invisible leak in a bucket you're using to carry water. A small leak over a long journey means you arrive with significantly less water. The expense ratio is that leak for your investment returns. For an actively managed U.S. stock fund, an expense ratio under 1% is a decent starting point. Under 0.75% is getting good. And if you can find a stellar fund under 0.6%, you're in elite territory. For a passively managed index fund, the numbers are much lower. Anything over 0.2% should raise an eyebrow. The best ones are often under 0.1%, some even approaching zero. Why does this matter so much? Because that percentage isn't a one-time fee. It's an annual charge on your entire investment. Let's run the numbers because this is where the reality hits hard. Imagine you invest $10,000 in two different funds, both of which earn an average of 8% per year for 30 years. Fund A has a 1% expense ratio, which sounds small. Fund B has a 0.2% expense ratio. After 30 years, your investment in Fund B, the low-cost fund, would be worth about $95,000. Not bad. But your investment in Fund A, the one with that small 1% fee, it would be worth only $76,000. That's a $19,000 difference. You lost nearly double your initial investment to fees. The leak in the bucket wasn't so small after all. It was a slow, silent drain on your wealth. High expense ratios are the single biggest hurdle to long-term performance. It's the headwind your fund manager has to fight against every single year, just to break even with the market. So, where do you find this number and all the other critical details? In the single most important document you'll ever read about a fund, the prospectus. Now I know what you're thinking. A prospectus? Isn't that a 100-page legal document written in a language only lawyers understand? Yes, the full prospectus can be a monster. But we're not going to read that. We're going to use a cheat code, the summary prospectus. This is a condensed, user-friendly version that funds are required by law to provide. It's the owner's manual for your investment, and you only need to focus on a few key sections to get 90% of the value. First, look for investment objective and principal investment strategies. This is the fund telling you in plain English what it's trying to do. Is it aiming for long-term growth? Income? A mix of both? Is it investing in large, stable US companies or risky, emerging international stocks? The first question you must ask is, does this fund's goal align with my goal? If you're a 25-year-old saving for retirement in 40 years, a fund whose objective is capital preservation is probably not for you. If you're 65 and need to live off your investments, a fund focused on aggressive growth in speculative technology is a screaming red flag. This section is your first and most important filter. Next, scroll down to principal risks. This is my favorite part because it's where the fund is forced to tell you exactly how you could lose money. Don't gloss over this. Read it carefully. Are you seeing market risk? Of course, every stock fund has that. But are you seeing other things? Concentration risk means the fund might be putting a huge chunk of its money into just a few stocks or one specific industry. That's less of a diversified fund and more of a high-stakes bet. Are you seeing derivatives risk or leverage risk? That tells you the manager is using complex financial instruments that can amplify both gains and losses. It's like they're driving a race car instead of a family sedan. You need to know if you're comfortable with that level of speed and potential for a crash. After you understand the risks, you'll find the fees and expenses table. This is where you verify that expense ratio we just talked about. But look closer. Are there other fees? Some funds have a purchase fee or a redemption fee if you buy or sell within a certain period. And you absolutely want to look for something called a 12b-1 fee. This is a sneaky fee hidden inside the expense ratio that's used for marketing and advertising the fund. It does nothing to improve performance. It's you, the investor, paying the fund to go out and find more investors. A high 12b-1 fee is a sign of a fund that is more focused on asset gathering than on investment management. The prospectus gives you the what. It's the rule book. But to understand the how and the why, you need to graduate to the next level. The fund's annual or semi-annual report, specifically the letter to shareholders from the fund manager. This letter is your window into the mind of the person steering the ship. A great manager's letter is clear, candid, and insightful. A bad one is a masterpiece of corporate jargon and blame shifting. Here's what you're looking for. First, honesty and accountability. When the fund has a bad year, and all funds will have bad years, how does the manager explain it? Do they take ownership? Do they say, "We made a mistake by overweighting this sector, and here's what we learned"? Or do they blame everything on the Federal Reserve, the market, politics, and the weather? A manager who can't admit a mistake is a manager who can't learn from one. Look for humility. Look for a manager who treats you like an intelligent partner in the business, not just a source of capital. Second, consistency. Does the story in the letter match the strategy in the prospectus? If the prospectus says it's a deep value fund that buys unloved, boring companies, but the manager's letter is excitedly talking about their new positions in the hottest, most popular tech stocks, you have a serious disconnect. This is called style drift. It means the manager is chasing performance and abandoning the very discipline you hired them for. It's a massive red flag. The letter should reinforce the strategy, not contradict it. Third, look for insight, not just a recap. A lazy manager's letter will just tell you what happened in the market last year. The S&P 500 was up X% and interest rates did Y. You can get that information anywhere. A great manager tells you why they made the decisions they did in the context of that market. They'll explain their thesis. For example, we sold our position in Company X not because it's a bad company, but because its stock price grew to a point where we no longer see a margin of safety. We reallocated that capital to Company Y, which is currently out of favor, but has these 3 specific catalysts for future growth. That is a world of difference. It shows you a disciplined process is at work. So let's connect these dots. You found a fund with a strong 10-year track record. You check the expense ratio and it's a reasonable 0.7%. Great. You open the summary prospectus. The objective is long-term growth through investment in U.S. large-cap companies, which matches your goal. The principal risks are standard market risks, Nothing exotic. Perfect. Then you read the manager's latest letter. He talks with incredible candor about 2 stocks that went against him, why his initial thesis was wrong, and the lessons learned. He then clearly articulates why he believes the fund's top 10 holdings are positioned to outperform over the next 5 years, tying it back to the core investment philosophy outlined in the prospectus. What you have now is a complete, coherent picture. The numbers are good, the rules are clear, and the manager's thinking is transparent and consistent. This is how you build conviction. This is how you move from being a speculator chasing hot dots on a chart to being a true long-term investor. But what if you want an outside opinion? An unbiased, third-party analysis to confirm your research or point out something you might have missed? How can you use powerful professional-grade tools, many of which are free, to stress test your thesis and compare your chosen fund against its direct competitors? That requires a whole new toolkit, and it's where we're headed next. Alright, let's open the toolkit. The first and most indispensable weapon in our arsenal, the one that's considered the gold standard for independent investment research, is Morningstar. Think of it as the Kelley Blue Book for mutual funds. It's where everyone, from seasoned financial advisors to curious beginners, goes to get the unvarnished data. And the best part? The vast majority of the information we need is completely free. When you first pull up a fund on Morningstar, you're hit with a wall of numbers, charts, and ratings. It can be intimidating, but we're going to slice through the noise and focus on the 5 critical areas that tell you 90% of the story. First, your eyes will immediately be drawn to the star rating. You'll see 1 to 5 stars sitting right at the top of the page. And our brains are conditioned to think 5 stars, that's the best, right? 4 stars, pretty good. 1 star, stay away. But this is the first major trap for new investors. The Morningstar star rating is purely quantitative and backward-looking. It's a mathematical calculation of a fund's past performance, adjusted for risk, compared to other funds in its category. A 5-star fund is one that has performed in the top 10% of its peer group over the last 3, 5, and 10 years. While that's useful information, it's like driving by looking only in the rearview mirror. Past performance, as every disclaimer reminds us, is no guarantee of future results. A fund could have gotten lucky with a hot sector, or the star manager who earned those 5 stars could have left last year. So, we look at the star rating, we acknowledge it, but we don't make our decision based on it. It's a starting point, not the finish line. The real gold is often right next to it, the Morningstar analyst rating. This is different. This is forward-looking. This is where a team of human analysts does the kind of deep dive work we've been talking about. They interview the fund managers. They analyze their decision-making process. They scrutinize the parent company that runs the fund. They rate the fund based on 3 pillars: people, process, and parent. Based on this qualitative research, they assign a medalist rating of gold, silver, bronze, neutral, or negative. A gold, silver, or bronze rating means the analysts believe the fund has structural advantages that will allow it to outperform its benchmark and peer group over a full market cycle. This is their high conviction list. A neutral rating means they don't see any significant advantage or disadvantage, and a negative rating is a clear red flag. If the fund you're researching has a gold or silver rating, you know that professional, unbiased analysts have looked at the same things you have, the manager, the strategy, and have come to a very positive conclusion. This is a massive confidence booster. A 5-star rating combined with a gold medalist rating? Now that's a powerful combination. Next, we scroll down to the performance section. This is where we verify the track record. You'll see a chart showing trailing returns. This shows the fund's annualized performance over the last year, 3 years, 5 years, 10 years, and even 15 years. But looking at these numbers in isolation is useless. A fund that returned 10% sounds great, until you realize every other fund in its category returned 12%. This is why Morningstar includes 2 other crucial lines in that chart: the category average and the benchmark index return. The category average shows you how your fund performed against its direct competitors. Is it in the top quartile? The bottom? The benchmark index, like the S&P 500 for a large-cap U.S. stock fund, is the ultimate measuring stick. A truly skilled manager should be able to consistently beat both their direct peers and the passive index over the long term, especially after accounting for their fees. We're looking for a consistent pattern of outperformance across multiple time periods, not just a single great year. Even more powerful is the growth of $10,000 chart. This is a visual representation of performance. It shows you what would have happened if you invested 10 grand in the fund 10 years ago versus investing it in the benchmark index or the category average. Seeing that line climb steadily above the others provides a gut-level understanding of the manager's skill, in a way that a table of numbers just can't. But returns are only half the story. The other, and arguably more important half is risk. How bumpy was the ride to get those returns? This is what separates amateur investors from sophisticated ones. Amateurs chase returns, pros analyze risk. On the Risk tab in Morningstar, we look for a few key metrics. The first is standard deviation. Don't let the name scare you. It's simply a measure of volatility. Think of it as the suspension system on a car. A low standard deviation is like a luxury sedan. A smooth, comfortable ride. A high standard deviation is like a sports car with stiff suspension. You'll feel every single bump in the road. A higher number means the fund's price swings up and down more dramatically. There's no right or wrong number. But you need to know what you're signing up for. Does this fund's volatility match your personal tolerance for risk? The next metric is the Sharpe ratio. This is one of my absolute favorites. The Sharpe ratio is the bang for your buck number. It measures how much return you got for each unit of risk you took. A higher Sharpe ratio is always better. If Fund A and Fund B both returned 10%, but Fund A had a much higher Sharpe ratio, it means Fund A achieved that return with a much smoother, less volatile ride. It was more efficient. It's the manager who gets you to your destination safely and comfortably, not the one who's swerving all over the highway. Finally, for a slightly more advanced view, look at the upside and downside capture ratios. This tells you how a fund performs in different market environments. An upside capture ratio of 110 means that when the market went up, the fund went up 10% more. That's great. A downside capture ratio of 90 means that when the market went down, the fund only went down 90% as much. It protected your capital better on the way down. An ideal fund manager captures more of the market's gains and less of its losses. This is the hallmark of a skilled defensive player, and it's what helps you sleep at night during a market correction. After we've stress-tested the performance and risk, it's time to pop the hood and look at the engine itself. We click on the Portfolio tab. This is where we verify that the fund is actually doing what it says it's doing. The first thing to check is the top 10 holdings. This shows you the fund's 10 biggest stock positions. Are these companies you recognize? Are they the kinds of businesses you expected to see based on the fund strategy? How concentrated is the fund? If the top 10 holdings make up 50 or 60% of the portfolio, you're making a very concentrated bet on the manager's best ideas. If it's only 20%, it's much more diversified. Again, neither is inherently better, but it has to align with your expectations. We also look at the sector weightings. If a fund calls itself a technology fund, you'd expect to see a huge allocation to the tech sector. If you look and see it's only 40% tech and has 20% in industrial companies, that's a mismatch. It's a sign the manager might be straying from their stated mandate, a phenomenon known as style drift. Morningstar's famous style box, that 9-square grid that shows you if a fund is large, mid, or small cap, and value, blend, or growth, is the ultimate tool for verifying a fund's investment style at a glance. By going through these steps on Morningstar, evaluating the analyst rating, comparing performance against the right benchmarks, assessing risk through metrics like the Sharpe ratio, and finally verifying the portfolio holdings, we move from a vague idea to a well-supported investment thesis. We've used a professional-grade tool to confirm the story the fund tells with cold, hard data. But this is still just looking at one fund in isolation. What happens when we start to build a portfolio of 2, 3, or even 4 of these carefully selected funds? How do we know they aren't all just buying the exact same stocks? Are we truly diversified, or have we accidentally created a portfolio that's heavily concentrated in just a handful of names like Apple and Microsoft spread across different fund wrappers? Answering that question requires a tool that can look across funds and give us an X-ray of our entire combined portfolio. It's how we spot the hidden overlaps and ensure our diversification is real, not just an illusion. And the most powerful tool for this, the one that gives us these financial X-ray specs, is a concept pioneered by Morningstar called the Portfolio X-ray. Now, this isn't a sponsored plug. It's just that their tool has become the industry benchmark for this kind of deep dive analysis, and similar features are now offered by many top-tier brokerages and financial planning platforms. The principle is what matters. The principle is to stop looking at your funds as individual silos and start looking at them as one single consolidated portfolio. Because here's the trap that snares millions of well-intentioned investors. You decide you need to diversify, so you buy an S&P 500 index fund. Great start. Then you hear large cap growth is the place to be, so you buy a popular large cap growth fund. Then a friend tells you about a fantastic total stock market fund, and you add that to the mix. You look at your statement and see 3 different fund names. You feel diversified. You feel smart. But you're not. You've fallen for the illusion of diversification. What you've likely done is bought the same handful of megacap tech stocks 3 different times. Your S&P 500 fund is dominated by Apple, Microsoft, Nvidia, and Amazon. Your large cap growth fund? Guess what? It's also dominated by Apple, Microsoft, Nvidia, and Amazon. And your total stock market fund? You guessed it. The exact same companies are sitting at the top, just in slightly different proportions. You haven't diversified. You've diversified. You've tripled down on the exact same bet, thinking you were spreading your risk. This is how a tech bubble or a downturn in a single sector can absolutely decimate a portfolio that, on the surface, looked perfectly balanced. The portfolio X-ray smashes this illusion to pieces. It forces you to see the truth. The process is surprisingly simple. You gather the ticker symbols for every single mutual fund, ETF, and even individual stock you own. You then input each ticker into the tool, along with the dollar amount or number of shares you hold in that position. You do this for your 401k, your IRA, your spouse's IRA, your taxable brokerage account, everything. You are building a complete holistic picture of your financial life. Once you've entered all your holdings, you click the button, Show My X-ray. And what comes back is one of the most eye-opening financial reports you will ever see. It's not a list of your funds. It's a consolidated, see-through analysis of what you actually own aggregated from all those different accounts and funds. The first thing you'll probably look at is the stock intersection, or top holdings section. This is the moment of truth. The tool doesn't just list the top 10 holdings of each fund side by side. No, it calculates your effective holding in each company across your entire portfolio. You might see that Microsoft makes up 7.1% of your S&P 500 fund, 8.5% of your tech sector fund, and 6.5% of your large cap blend fund. Before, you just saw 3 funds. Now the X-ray tells you that, in total, Microsoft isn't a 7% position for you. It's a staggering 14% of your total equity portfolio. You have accidentally made a massive, concentrated bet on a single company without even realizing it. This single insight is worth the entire exercise. It reveals the hidden concentration risk that could sink your ship, but it goes so much deeper. The next section you'll see is your true, underlying asset allocation. You might have meticulously planned to have a 70% stock and 30% bond portfolio. You bought funds that you thought reflected this. But after the X-ray combines everything, it might reveal that your balanced funds were more aggressive than you thought, and your bond funds had some equity-like characteristics. The final report comes back and you're not 70-30 at all. You're actually 88% in stocks and only 12% in bonds. Your actual risk profile is wildly different from your intended risk profile. This explains why your portfolio was so volatile in the last downturn, and it gives you a clear roadmap to fix it. Then you get to the sector and style exposures. This is where you see your thematic bets, whether you intended to make them or not. You click on the sector breakdown and a pie chart appears. You thought you were a well-rounded investor, with healthy exposure to healthcare, financials, and industrials. But the chart staring back at you is a giant, pulsating block of blue labeled technology, taking up 45% of your entire portfolio. You didn't decide to bet the farm on tech. The funds you chose made that decision for you silently in the background. Now, for the first time, you can see it. You can see your vulnerability to a single sector downturn. Next to it is the famous Morningstar style box. It's that 9-square grid that plots investments based on size, large, mid, or small cap, and style, value, blend, or growth. Every fund you own has its own style box, showing its center of gravity, but the Portfolio X-ray gives you the master style box. It combines all your funds and shows you where your entire portfolio's center of gravity lies. You might discover that even though you own a dozen different funds, 90% of your money is clustered in one single square. Large cap growth. You have virtually no exposure to small cap stocks, and your portfolio is completely devoid of value stocks. You're not fishing in the whole pond. You're fishing with a single hook in a tiny, crowded corner, hoping that one specific type of fish keeps biting. This is the opposite of diversification. Seeing this report for the first time is a transformative experience. It's the investing equivalent of turning on the lights in a dark room you've been stumbling around in for years. All the hidden risks, the unintentional concentrations, and the portfolio drift that has happened over time are laid bare. So what do you do with this newfound, sometimes terrifying clarity? The goal is not to eliminate overlap entirely. If you own two broad market index funds, there will naturally be overlap, and that's okay. The goal is to understand and manage unintentional and undesirable concentration. You look at that X-ray and you ask yourself some hard questions. Am I comfortable with having 14% of my life savings effectively tied to the performance of a single stock? Am I comfortable with a portfolio that is 45% exposed to the tech sector's volatility? Do I really want to be 90% invested in large-cap growth stocks when historical data shows that other asset classes like small-cap value have periods of significant outperformance? The X-ray doesn't tell you what to sell. It gives you the diagnostic data to make an informed decision. You might decide to trim the fund that contributes most to your overconcentration in Apple. You might sell one of your 3 large-cap growth funds and use the proceeds to buy a fund that gives you exposure to a completely different part of the market. Maybe an international small-cap value fund, or a real estate investment trust fund, or a fund focused on emerging markets. You are no longer just guessing. You are performing surgery on your portfolio with precision, using a data-driven map of exactly where your assets are. This process of X-raying your portfolio is not a one-time event. It's a crucial piece of your annual financial checkup. You should do it at least once a year to ensure your carefully constructed plan hasn't been secretly undermined by market movements and fund manager decisions. This analysis is the bridge from being a passive fund collector to becoming a true portfolio architect. You've identified the weak points, the overconcentrations, and the gaping holes in your strategy. And that brings us to the next critical step in our journey. Now that we know exactly what our portfolio is missing, how do we go out and find the perfect fund to fill that gap? How do we sift through the thousands of available options to find a high-quality, low-cost fund that provides the exact exposure we now know we need? For that, we need to master another powerful tool, the mutual fund screener. Think of a mutual fund screener as the most powerful search engine you've ever used, but instead of finding cat videos or recipes, it finds investment opportunities. It's your mission control panel. Right now, there are over 7,000 mutual funds available in the United States. Trying to research them one by one would be like trying to boil the ocean. It's impossible. A screener allows us to input our exact criteria, the things we've just spent all this time learning about, and it instantly filters that universe of 7,000 funds down to a small, manageable list of top-tier candidates. It turns the haystack into a handful of shiny needles. Now you can find these screeners for free on almost any major financial website. Your brokerage, whether it's Fidelity, Charles Schwab, Vanguard, will have a fantastic one. Independent sites like Morningstar or Yahoo Finance also offer powerful free versions. For our purposes, it doesn't matter which one you use because the core principles, the filters we are about to apply, are universal. They all work the same way. So let's pull up our virtual screener and begin our search. Imagine the screen is in front of you. You see a daunting list of thousands of funds. Our job is to strategically apply filters to whittle this down. The very first, non-negotiable filter we apply is the one that saves us money before we even start. We are looking for 2 magic phrases: no load and no transaction fee, or NTF. Let's break that down. A load is just a fancy word for a sales commission. A front-end load means you pay a commission, sometimes as high as 5%, just to buy the fund. If you invest $10,000, $500 is immediately gone before your money even has a chance to grow. A back-end load means you pay a commission when you sell. In today's world with so many high-quality options, there is absolutely no reason to pay a sales load. So we immediately filter for no-load funds only. Click. Instantly, thousands of funds vanish from our list. Next is no transaction fee, or NTF. Some brokerage platforms will charge you a fee, maybe $50, just to execute a trade to buy a fund that isn't on their special pre-approved list. Again, why pay that if you don't have to? By selecting NTF, we ensure we're only looking at funds our brokerage will let us buy and sell for free. Click. The list shrinks again. With just 2 clicks, we've eliminated all the funds that charge us unnecessary fees just for showing up. We're already investing smarter. Okay, our list is smaller, but it's still a random assortment of funds. Now we need to tell the screener what kind of fund we're looking for. This goes directly back to our portfolio analysis from the last part. We identified a gap, right? Let's say we realized we were underweight in US large-cap growth stocks. This is where we get specific. The screener will have a category for asset class. First, we select stocks or equities. Then it will likely let us narrow down by region. We select US. Then comes the most important part, the category or style box filter. We're looking for large cap, for the company size, and growth, for the investment style. We select those two attributes. Click. And just like that, our massive list has been cut down to only the funds that match the exact strategic gap we need to fill. We are no longer looking at international bond funds, small cap value funds, or anything else that doesn't fit our specific mission. We've gone from thousands of options to maybe a few hundred. This is progress, but we're not done yet. A few hundred is still too many to research individually. Our next filter is another crucial cost cutter, the expense ratio. Remember, this is the annual fee the fund charges to manage your money, expressed as a percentage. It gets deducted from your returns every single year, so a lower number is almost always better. This is one of the single greatest predictors of a fund's future success. We want to eliminate the expensive funds right away. So we find the expense ratio filter. We can set a maximum. What's a good maximum? For an actively managed US stock fund, a good rule of thumb is to look for something under 0.75% and ideally under 0.5%. For an index fund, we want that number to be razor thin, like under 0.1%. Let's be aggressive. We'll set our maximum expense ratio to 0.75%. Click. Boom. Another huge chunk of the list disappears. These were the funds that were charging too much for the privilege of investing. We don't need them. Now we're getting to the exciting part. We've filtered by cost and by category. Now we filter for quality and performance, the strong track record. Most screeners will let you filter by historical returns. You'll see options for 1 year, 3 year, 5 year, and 10-year annualized returns. Here is where we need to be smart. It's tempting to just sort the list by the 1-year return and pick the one at the top. This is a classic beginner's mistake. A fund can have one lucky year for a million different reasons. We're not looking for a flash in the pan. We're looking for consistent, long-term excellence. So we use the 5-year and 10-year returns as our primary guide. A great way to do this is to filter for funds that have performed in the top 25%, the top quartile of their category over the last 5 or 10 years. This shows they aren't just good. They're consistently better than 3/4 of their direct competitors over a meaningful period. This is a powerful indicator of a skilled management team. So we'll add that filter. 5-year return in top quartile. Click. The list gets even smaller, even more elite. But a track record isn't just about numbers. It's about the people who generated those numbers. This brings us to a pro-level filter that many people overlook: manager tenure. Think about it. If a fund has a fantastic 10-year track record, but the star portfolio manager who achieved those results just retired last month and was replaced by a rookie, how much is that 10-year record really worth to you, the future investor? Not much. The track record belongs to the manager, not the fund's name. We want to find funds where the management has been stable. So we look for the manager tenure filter and set a minimum. A good minimum is at least 5 years and ideally closer to 10. This ensures that the manager currently at the helm is the same one responsible for the majority of the great long-term performance we just filtered for. We are investing in their skill, so we want to make sure they're still in the driver's seat. We set the minimum tenure to 5 years. Click. And there it is. Look at our screen now. We started with over 7,000 funds. A chaotic, overwhelming sea of choices. Now, after applying a series of logical strategic filters based on cost, category, and consistent, well-managed performance, we are left with a small elite group. Maybe it's 10 funds. Maybe it's 5. Maybe it's 15. This is our shortlist. This is the pool of A players from which we will select our next investment. We've done the hard work of clearing away all the noise, all the expensive, underperforming, and unsuitable options. We have successfully panned for gold and now have a handful of promising nuggets in our pan. But our work isn't quite done. This shortlist is fantastic, but how do we analyze these final contenders side by side? How do we read the fund's prospectus to uncover any hidden risks? How do we look under the hood to see their top 10 holdings and make the final confident decision of which one fund to actually buy? We've gone from prospector to finalist. Now we need to become the jeweler, examining each of these gems under the microscope to find the one that is truly flawless for our portfolio. This is the final round, the championship match. We have our 3 to 5 finalist funds, each one a proven winner, each one glittering with promise. But investing isn't about collecting a handful of shiny objects. It's about selecting the one that perfectly fits the setting of your financial life. So we place these gems under our jeweler's loupe. and we start looking for the tiny details that separate the good from the truly great. Our first, and arguably most important magnification is on risk. See, anyone can look like a genius in a bull market. When everything is going up, it's easy to post big numbers. But a strong track record isn't just about the height of the peaks, it's about the depth of the valleys. We need to know how much turbulence the pilot put the plane through to get to the destination. This is where we introduce a concept called risk-adjusted return. The most common way to measure this is the Sharpe ratio. Now, don't let the name intimidate you. The concept is beautifully simple. It asks, for every unit of risk you took on, how much return did you get back? A higher Sharpe ratio is better. It means the fund manager was more efficient, generating more bang for your risk buck. Imagine two funds, Fund A and Fund B. Over 5 years, they both returned an average of 12%. On the surface, they look identical, but then you look at their Sharpe ratios. Fund A has a Sharpe ratio of 1.2, while Fund B is at 0.7. This tells you a powerful story. Fund A achieved that 12% return with a smooth, steady climb. Fund B got to the same place, but its journey was a white-knuckle roller coaster of massive swings up and down. Which ride would you rather be on for the next 10, 20, or 30 years? The Sharpe ratio helps you answer that. You can usually find this number on Morningstar or your brokerage's research page. When comparing your finalist funds, line up their 3-year, 5-year, and 10-year Sharpe ratios. Is there a clear winner? Is one fund consistently more efficient at generating returns than the others? This is a massive clue, but we can go even deeper. The Sharpe ratio treats all volatility, both the exciting pops to the upside and the terrifying drops to the downside, as equal. But let's be honest, we don't mind the upside volatility, do we? It's the downside risk that keeps us up at night. That's why an even more precise tool is the Sortino ratio. It's like the Sharpe ratio's smarter cousin. It only looks at the bad volatility, the downside risk, and asks the same question. How much return did you get for each unit of bad risk? Again, a higher Sortino ratio is better. It tells you which manager is best at protecting your capital when the market gets ugly. So that's test number 1, the efficiency test. Who delivered the best returns for the risk they took? Next, we move to test number 2, the hurricane test. This is measured by something called the downside capture ratio. This might be the most important number you've never heard of. It answers a simple question. When the overall market goes down, how much does this fund go down? A downside capture ratio of 90% means that if the market drops 10%, this fund tends to drop about 9%. A ratio of 110% means if the market drops 10%, this fund tends to drop a painful 11%. You want this number to be as low as possible, ideally below 100%. A fund with a low downside capture ratio is like a well-built ship. It might not be the fastest speedboat in calm seas, but when the storm hits, it provides shelter and minimizes damage. This is critical because of the brutal math of losses. If your portfolio drops 50%, you don't need a 50% gain to get back to even. You need a 100% gain, a full doubling of your money, just to get back to where you started. Protecting the downside is often the single most important ingredient for long-term success. So, look at your finalist funds. Go back to 2022, the last major down year. Or look at the fourth quarter of 2018. Or the COVID crash in early 2020. How did your funds perform during those specific terrifying periods? Did one hold up remarkably well while the others plummeted with the market? That fund has a manager who prioritizes risk management. That is a jeweler's mark of quality. Now that we've stress-tested the numbers, it's time for the third and most human test, examining the manager and their team. A mutual fund isn't a robot. It's run by people. People with philosophies, biases, and careers. The first thing you need to check is manager tenure. Has the same manager who produced that incredible 10-year track record actually been there for all 10 years? You'd be shocked how often a fund is coasting on the reputation of a manager who left 2 years ago. You're looking for consistency. A manager who has been at the helm for a decade or more has been through multiple market cycles. They've been tested by fire. If the manager is new, you have to ask yourself, am I investing in the fund's historical record, or am I betting on this new person? Then dig into their philosophy. Read the fund's prospectus or shareholder reports. Is the manager a deep value investor, looking for discarded cigar butts? Are they a high-growth investor searching for the next Amazon? Does their strategy make sense to you? Do you believe in it? You are not just buying stocks. You are hiring a professional to manage your money. You should be comfortable with their approach. Also, consider the structure of the team. Is this a star manager system, where one legendary individual makes all the calls? This can be fantastic until that person retires or gets poached by a competitor. This is called key man risk. Or is it a team-managed approach, with a deep bench of analysts and co-managers? This might be less glamorous, but it often provides more stability and continuity over the long run. There's no right answer, but you need to know what you're buying into. Are you betting on a single genius or a time-tested process? Finally, we conduct our fourth and final test. We pop the hood and look at what's actually inside the portfolio. Don't just trust the fund's name. A US large-cap growth fund could look very different from one manager to the next. Go to the fund's holdings page. Look at the top 10 positions. Do you recognize the names? Do they align with the fund's stated strategy? More importantly, look at the concentration. Is the number one holding 15% of the entire fund? That's an extremely concentrated, high-conviction bet. It could lead to spectacular returns if that one stock does well, or devastating losses if it doesn't. Another fund might have its top holding at only 4% of the portfolio. That's a more diversified, less risky approach. Which one makes you more comfortable? Also, check the sector weightings. Is the fund 40% in technology stocks? If so, you have to be prepared for a wild ride that is heavily tied to the fate of that one sector. A different fund might be more balanced across financials, healthcare, consumer staples, and industrials. This is a crucial check. It ensures you're not unknowingly doubling down on a sector you already have a lot of exposure to in other parts of your portfolio. So now, the moment of truth. You have your 3 to 5 finalists lined up. You've compared their risk-adjusted returns using the Sharpe and Sortino ratios. You've stress-tested them with the downside capture ratio. You've investigated the manager and their philosophy. And you've looked under the hood at the actual holdings. One or two funds will likely start to pull away from the pack. Maybe one has a slightly lower 10-year return, but its risk metrics are vastly superior. Its manager has been there for 15 years, and its portfolio is perfectly balanced for your taste. Another might have the best raw performance, but you realize it's driven by a massive, concentrated bet on one stock, and the star manager just left last year. This is where the art of investing meets the science. The data gets you to the finish line, but your own personal goals, your risk tolerance, and your gut feeling have to carry you across it. You're not looking for the objective, best fund in the world. You're looking for the best fund for you. By going through this final rigorous comparison, you move beyond being a mere speculator. You become a true investor. You understand not just what you are buying, but why you are buying it. You know its strengths, its weaknesses, its engine, and its pilot. And that knowledge, that deep conviction, is the ultimate armor you'll need to hold on through the inevitable market storms to come. You've made your choice. The jeweler has identified the perfect gem. Now all that's left is to actually make the purchase and set it in your portfolio. But how do you do that in the smartest way possible? And even more critically, how do you know when it's time to sell? Let's talk about execution, because a brilliant plan is worthless without action. Buying a mutual fund is actually the simplest part of this entire process. You have two primary paths. First, you can go directly to the fund company's website, think Fidelity, Vanguard, or T. Rowe Price. You open an account with them, link your bank account, and buy their funds directly. It's straightforward, and their platforms are designed to be user-friendly. The second path is through a brokerage account like Charles Schwab, E*TRADE, or TD Ameritrade. The advantage here is consolidation. You can buy funds from many different companies, along with stocks, ETFs, and other investments, all under one roof. This makes it easier to see your entire financial picture in one place. Regardless of which path you choose, the process is similar. You'll look up the fund using its ticker symbol, that 5-letter code we talked about, and you'll decide how much money you want to invest. Now, here's a critical difference between mutual funds and stocks. When you buy a stock, you see a price and you buy it at that exact moment. With a mutual fund, it doesn't work that way. All buy and sell orders placed throughout the day are pooled together. At the end of the trading day, after the market closes, the fund company calculates the fund's net asset value, or NAV. That's the final official price for the day, and that's the price you get. So don't be surprised if you place an order at 11 a.m. and don't see the transaction completed until that evening. That's just how the system works. Now, for the strategy of buying, do you take your $10,000 and throw it all in at once? That's called lump sum investing, and it can be terrifying. What if you invest it all the day before the market takes a nosedive? The smarter, more disciplined, and psychologically easier approach for most people is called dollar cost averaging. Imagine you've committed to investing $500 a month into your chosen fund. The first month, the fund's price is $50 a share. Your $500 buys you 10 shares. The next month, the market gets shaky and the price drops to $40. Your same $500 now buys you 12.5 shares. The month after that, the market recovers and the price is back to $50. Your $500 buys you 10 shares again. Look what just happened. You didn't panic. You didn't try to time the market. You stuck to your plan. By investing a fixed amount of money on a regular schedule, you automatically buy more shares when the price is low and fewer shares when the price is high. It forces you to buy on sale. Over time, this smooths out your average cost per share and reduces the risk of bad timing. More importantly, it removes emotion from the equation. It turns investing into a habit like paying a bill you pay to your future self. Almost every brokerage and fund company lets you set this up automatically. It is the single most powerful tool for building wealth consistently over the long term. So you've done the research, you've set up your automatic investment plan, and you're buying shares every month. Now comes the hardest question in all of investing, the one that separates amateurs from seasoned pros. When do you sell? First, let's talk about the wrong reasons to sell. The number one mistake is selling out of fear. The market drops 15%. The headlines are screaming about a recession. Your stomach is in knots. The impulse to sell everything and go to cash is overwhelming. But this is precisely how you lock in your losses and destroy your long-term returns. Remember, when you own a mutual fund, you own a piece of real operating businesses. A dip in the stock market doesn't mean those companies vanished. Selling in a panic is like running out of your house in a thunderstorm and selling it for half price, only to watch the sun come out an hour later and have to buy it back for more. History has shown time and time again that the market always recovers. The cost of missing the best recovery days is far greater than the pain of the downturns. The second wrong reason to sell is chasing performance. Your fund has a bad year. It's down 5%. Meanwhile, some other fund in a different category is up 30%. So you sell your fund and jump into last year's winner. This is a textbook recipe for buying high and selling low. Every investment style goes through periods of underperformance. Chasing hot dots is a losing game. Stick to the plan you made when you were thinking logically and unemotionally. So, what are the right reasons to sell? There are really only a few. The first and happiest reason is that you've reached your financial goal. You were investing for a down payment on a house. You've hit your number. It's time to sell the fund, take your money out of the market, and protect it for its intended purpose. The fund did its job. Mission accomplished. The second reason is for rebalancing. Let's say you started with a plan to have 10% of your portfolio in this one fund, but it has performed so exceptionally well over 5 years that it now represents 30% of your portfolio. While that's a great problem to have, it also means your portfolio is now much riskier and less diversified than you intended. The smart move is to sell a portion of that winning fund, not all of it, and reinvest the profits into other parts of your portfolio that are lagging. This is like pruning a tree. It's a disciplined, strategic move to manage risk, not an emotional reaction. The third and most critical reason to sell is when the fundamental thesis for your investment has changed. This is where all that research you did upfront pays off. You sell when the reasons you bought the fund in the first place are no longer true. What does that look like? The star fund manager, the one with the 20-year track record of genius you analyzed, suddenly retires or leaves the firm. The new manager might be great, but they are an unknown. The track record you bought is gone. That is a legitimate reason to reevaluate and potentially sell. Or you notice strategy drift. Your small cap value fund, which you bought for its specific discipline, starts buying large, flashy tech stocks to chase a hot market. It's no longer the fund you researched. It has abandoned the very process that made it successful. Time to sell. Maybe the expense ratio suddenly jumps up. The fund company gets greedy and decides to start charging you significantly more for the same service. Your thesis was based on a low-cost, high-performing fund. If one part of that equation changes for the worse, you have a reason to sell. And finally, there's sustained underperformance. This is the trickiest one. I'm not talking about one bad quarter or even one bad year. Every great manager has those. I'm talking about a consistent pattern over 3, 4, or 5 years, where the fund is not just trailing the market, but is consistently trailing its direct benchmark and its peer group. This indicates that the manager may have lost their edge, or that their strategy is no longer effective. Your research showed a history of outperformance. If you're now seeing a clear history of underperformance, the facts have changed and it's okay to sell and move on. Notice what all these valid reasons have in common. They are based on logic, data, and changes to the fundamental story of the fund, not on market noise or your own fear. You have now walked the entire path, from the fog of not knowing where to start, to the clarity of a defined process. You know how to define your goals, how to use screeners to narrow the field, how to read a prospectus, how to analyze a manager's skill, how to scrutinize fees, and how to judge performance in its proper context. And now, you know the mechanics of buying and, most importantly, the disciplined, logical framework for when to sell. This isn't just a series of tips. This is a blueprint for taking control of your financial future. The world of investing can seem complex and intimidating, designed to make you feel like you need to pay someone else to manage it for you. But you've seen that with the right framework, you are more than capable of making intelligent, informed decisions for yourself. The research is the work. The buying is the easy part. But the holding, the patience, the discipline to stick with your plan through market highs and lows, that is where true wealth is built. You now have the complete toolkit. The knowledge is yours. The only thing left to do is build.